A mortgage loan is a loan that you take on the piece of property that you want to buy. So if you're going to buy that house using a loan, that house is going to be used as a guarantee to the loan. So in case you default to pay that loan, they'll take your house. When you're taking this mortgage loan, there are going to be mainly two types of interest. There's the fixed interest and there's the variable interest. Now, with the fixed interest, you're going to be paying a fixed amount of interest for that period. Let's say the repayment period is 20 years and you are to be paying 20K each month. So you'll be paying 20K for the next 20 years. Then we have the other type of interest, which is the variable interest. So this interest keeps on changing. The interest that you'll pay this month is not the interest that you're going to pay next month if the market rates, if the CBK rate changes. There are factors that affect the interest rate. And if these factors affect the interest rate, then the interest that you're going to pay next month is going to be different from the interest that you're going to pay the other month. So what do financial institutions look at before they give you that mortgage? You want to buy that house. You want to take a loan to buy that piece of property. They are going to look at your bank. If it's a bank, they're going to look at your bank statement. They're going to look at your pay slip. If you are self-employed, if you own a business, then they will need to see how your cash flow has been from your business, or just how your cash flow to the bank looks like. The different types of mortgage loans, you necessarily don't have to buy a new property. So one of the loans that they can give is on buying a new house, just a new house. Then the other type of loan is where they give you a loan to construct the house. The other loan might be just to buy that land, so that in case you want to construct a house, you can do that. So it can be buying an already made house or constructing the house. They can finance that. So it actually depends. You don't have to tie yourself to buying something new. The mortgage loan can help you build your house from the ground up, just constructing it. Yep. A mortgage loan here in Kenya can also be geared towards helping you build not necessarily your own house, but building houses like residential houses, building offices. So it necessarily doesn't have to be tied down to you buying your own house. Most mortgage loans in Kenya require you to make a down payment. So let's say the house that you want to buy is worth 1 million. Yeah. So they might require you to make a down payment of, let's say, 10%, which is 100K. Then after that down payment, that's when you start paying off the interests. Apart from the mortgage loan itself, there are other fees that are charged which are not part of that mortgage loan, and there can be legal fees. There are stamp duty fees. There's the valuation fee, the insurance fee. There are other charges, so you have to look at the terms of the contract before you sign it. Now, having said all of that, do you think that taking a mortgage loan is a smart idea?